Hey everyone, and welcome to our May edition of the Markets in 2 Minutes. This is Connor Darrell, and this month we are going to try and frame some of the recent volatility we've experienced within a broader historical context. So one of the many unique things about 2022 thus far has been that there really hasn't been anywhere to hide from market losses to start the year. Unless your portfolio is predominantly invested in energy or commodities, your returns year to date have probably fallen within a relatively narrow range. And that includes both aggressive and conservative investors alike. In fact, if we take a conventional growth portfolio mix of about 80% stocks and 20% bonds, that portfolio is down about 14% this year. By comparison, a conservative portfolio of just 20% stocks and 80% bonds is down almost 11%. So no matter what the stock bond mix is in your portfolio, you've had pretty much the same experience so far this year. And the primary reason for that is that both stocks and bonds have suffered meaningful losses at the same time, which is something that you might be able to glean from the table here is exceedingly rare. But one other important observation that we wanted to highlight here this month is that when we put those drawdowns for stocks and bonds into historical perspective, there's potentially reason for conservative investors in particular to feel that the worst of the pain may actually be behind them at this point. We went through and pulled market data for the past 30 plus years and took a look at intra-year drawdowns for a variety of different asset classes. For core bonds, the drawdown in 2022 has been the largest we've seen in decades. So at this point, we've kind of pushed through what might historically be considered a very large loss for bond investors. In equity markets, on the other hand, historical drawdown data suggests that we still have the potential for further downside here. We've had intra-year losses on the equity side well in excess of 50% in the past, whereas this year we're only down in the 10 to 15% range. So what all this suggests to us is that 2022 has been a very extreme year for bonds, but not so much for equities. And that's going to help frame our expectations moving forward. And just to wrap things up on a hopefully more optimistic tone, it's important to keep in mind that market sell-offs like this represent good long-term entry points because there's a natural push and pull with respect to forward-looking return expectations and current market levels. So for example, lower market valuations suggest higher future returns and vice versa. So after having experienced a bit of a drawdown here, our expectations for future returns have subsequently moved a bit higher, to the point where that if an investor is uncomfortable with the type of volatility that they've seen in their portfolio recently, they could conceivably reduce risk and still maintain the type of long-term return expectations that might have accompanied their previously more aggressive portfolio just a few months prior. So that's going to be helpful, hopefully, to keep top of mind as we move forward into a market environment where volatility is likely to be quite a bit higher than what we've grown accustomed to in recent years. So I'll leave you with that thought and close up with our discussion for this month. And thanks for joining us. And our team will be back next month with some new insights.